Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mork-eitel.
All right, my name is Mark-eitel, and you are listening to the Mr. Mortgage Show. And guys, you're in the right place if you want the information, the data, the real stuff, not the headlines, but the real information that you need so you can go out there and make better real estate and mortgage decisions for you and your family. Dom, my right hand, my producer extraordinaire, and I do this each week right here, same time, same station. And thank you so much for spending a little bit of your day with us. We're going to make this fun, make it informative. And guys, your questions are super, super important to the show, and they are my favorite part. So write this number down. If you've got questions, you can call or text 855-462-7292. That's 855-462-7292. That is the Anytime Hotline. And guys, we call it the Anytime Hotline because when Dom and I are not in the studio making mortgage magic for you, that number pushes to my office. So 855-462-7292 is the way you can reach us, but also the way to get your questions on the air. Call or text them in, and Dom will read them on the air for you. Super excited to be with you. As I mentioned, we like to start each show just kind of dissecting the information of the week, and then we dive into those questions. So let's dig right in. You know, I like to poke fun at the headlines. And listen, real estate and mortgage is a super, super serious thing. It's a big, important part of all of our lives, and you can't not have somewhere to go home to, right? So we try to give you that data so you make the best decisions about buying a house, selling a house, and then obviously financing a house is the big piece that we're involved in. So the headlines often they always mislead us. And I get it. The news is a business and they want to grab our attention. And sadly, they're competing for our attention like never before. So the tactics they're using is a lot of clickbait and sensationalism. And we see headlines every week indicating that the housing market is crashing. But guys, the data doesn't show that. The data shows it's slowing. The data shows that fewer people are selling and fewer people are buying. Interest rates are definitely cooling demand, but they're not bringing values down to a negative number year over year. Their homes are still appreciating, albeit more slowly. And it got me thinking, right? Is this contradictory headline thing a new phenomenon, or has it been happening for a while? So I dug in, and I've got a series of headlines here in front of me. And guys, I'll post this to the Facebook page. If you want to read them for yourself, just go to Facebook and search out the Mr. Mortgage Show. But these are all from Diana Olick at CNBC. And I use her not because she's, easy to poke fun at, although sometimes she is. But for the record, I actually admire her. However, CNBC is a big player in the news. Internet, online. We see most of the news around housing coming from the big four, if you will, and CNBC is one of those. Whether you watch them online or watch the TV channel or not, we're seeing a lot of this news on the internet. And because of that, I think they're really fighting for attention because these headlines are crazy. Here's one that goes all the way back to October of 2015. It says, "Housing today, a bubble larger than 2006. Man, can you believe that? In 2015, they were saying we're in a housing bubble. That's 7 years ago. If you would have bought a house in 2015, you'd be sitting on a load of equity. You probably would have refinanced it, pulled some cash out, paid off a bunch of debt, or maybe pulled cash out and bought one or two other properties with that equity. But man, I would have loved to have purchased a property in October of 2015. Here's another one. November of 2017, homeownership doesn't build wealth, study finds. Guys, I will argue with the author of that study until the cows come home. Building equity wealth is a fundamental principle of real estate. It's the easiest way to accumulate wealth is going home every month, making that payment and you're building equity by reducing your principal and then obviously gaining some appreciation. So I couldn't disagree with that more. Homeownership does build wealth. And if you bought a home in 2017 when this headline was published, you'd have a lot of that equity wealth under your belt right now. Here's another one. It's better to rent than buy in today's market. And that was in 2018. Guys, if you signed a lease in 2018 versus bought a house in 2018, how much has your rent gone up since 2018? If you had a fixed rate mortgage, that mortgage payment, with the exception of increased insurance and a slight increase in taxes each year, that payment's not changing. The principal and interest portion of that payment never changes. So it makes sense to rent and not buy. That makes zero sense to me, unless you're in the area only for a short period of time. But here, let's keep it rolling because there's a bunch of them here. The housing market is about to shift in a bad way. That's from 2019. Here's another one. Next year will be hard on the housing market, especially in these big cities. That's from December of 2019. And I get it. They didn't know the pandemic was coming. None of us knew what it was going to do to housing. But there was no bad news in the housing market in 2019. And here's one from last year, June of 21. Housing boom may be cooling as weekly mortgage demand drops again. My point in this is not to poke holes in the articles. My point in this is to demonstrate to you that it's our duty to dig deep and find the real information. It's up to us to make the best decisions for us and our families. And if you're just catching the headline and not taking the time to dissect the data and make your own conclusion, you're misled. And we just demonstrated all the way back to 2015, and we could have kept this rolling. And I'm not saying they're always wrong, guys. That's not at all what I'm saying. But forecasting a housing crash is nothing new. And if you do it long enough, I guess eventually you'll be right. And maybe that's what they're up to. At some point, somebody's going to pull all these articles and stick them right back in my face and say, listen, they told us 7 years ago, 9 years ago, 15 years ago that this day was coming. And now that it's here, they're right on the money. So, real estate, interest rates, it's always moving up, down, good, bad, sideways. And you've got to make the decision for yourself. And I'm sorry if I sound a little fired up today. It was a super interesting week in the market. And, as interest rates continue this upward trend, although the last week or so they've fallen back a little bit, people are more and more critical of housing. And I don't look at housing like a stock or a bond or an annuity. I look at it as, first of all, it's necessary, because unless you're living in your mom's garage or sleeping on her couch, you're paying rent. It's not like that's a payment you can't do without. So I'm a big proponent of at least trying to buy that first property for yourself, and over time raising your family and living your life and building that equity wealth position for you that's going to benefit you so often later in life. I met a super cool couple this week that retired and sold their property in Ohio and paid off all their debt, and then bought a camper and did the whole nomadic, travel across the country and live the cool life and visit the state parks. And now they're settling into the Stewart area, and they're super excited. Well, guess what, guys? If they hadn't sold that property, if they hadn't have bought that property up north originally, sold it, cashed all that equity out, they would not have, in their normal cycle of life, saved enough money to pay off everything and drive around the country for a year. And now they still have enough money left over to put a big down payment on this property, and they're going to live happily ever after, getting sunburn on the beaches of Florida. So that's one more example, and I see it every day, day in and day out. And that's why I'm excited. That's why I want to encourage you not to be put off, not to be scared just because somebody on the television told you it's a bad time to buy, because it might be a bad time for you, but it might be the right time for you. And I'll always encourage you to take the steps necessary to find out for yourself. And guys, we are going to continue to dig into the data. We're going to answer your questions. Your questions are always my favorite part of the show, and you can get those to us by calling or texting 855-462-7292. That's 855-462-7292. That is the Mr. Mortgage Anytime Hotline. But hang in there. You hear the music? That means we're going to jump into a break. We'll be back in 2 short minutes with more of the show. It's not every day that you need an appraisal, whether it's for a divorce settlement, estate planning, or maybe you're appealing a tax assessment, or you just want to make sure you have adequate coverage in your property insurance. When you need a certified appraisal, turn to my friends at SOFLappraisal.com. That's SOFLappraisal.com. Peter and his team have been appraising properties here in South Florida for decades. SOFLappraisal.com. And tell him you heard this on the Mr. Mortgage Show.
Here's another 5-star review.
My wife and I own a small business. And the way our accountant file our taxes, we don't show much income on tax returns. Because of this, it looks as if we don't make the money. This was a problem for our bank when we applied for a mortgage. But not for Mark. He verifies our income by using our monthly bank statements. Mark and his Mr. Mortgage team made a big difference for me. Yes, I am happy to recommend Mr. Mortgage Mark.
Hey, it's Mark-eitel, host of the Mr. Mortgage Show. You hear me all the time talking about the need to have the very best team representing you in a real estate transaction. And that starts with a really great agent. If you've got a great agent, that's awesome. But if you don't, check out www.reallyGreatAgents.com. There you'll find the best of the best, regardless of the city they work in or the brokerage they work for. www.reallyGreatAgents.com, www.reallyGreatAgents.com.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark-eitel, and you heard the man. You're listening to the Mr. Mortgage Show, and if you have questions, you can call or text them to 855-462-7292, or if you prefer to do it via email, go to the internet and jump in the address bar on the top of your browser there and just type in Mr.Mortgage. Never a .com, just type in Mr., hit the period, type in mortgage, hit enter, will pop right up. In the upper right-hand corner of the page is the Contact Us box, and if you type your question there and hit submit, Dom will get it on the computer and read it for you right here on the air. So super excited to be with you. I was a little fired up in that first segment, but I've got all these headlines printed out in front of me, and it just makes me crazy. There were a couple more. You know, one on Friday, housing sales fell for the 9th straight month. And on the surface, I mean, that could mislead you into prices are coming down, and they're just not coming down yet. You know, prices are still appreciating, albeit at a much slower pace, but they are still appreciating. So guys, hang in there. The sky is not falling. You need a roof over your head. You might as well own it because it's going to build equity, and you can always rent it out if you wanted to move and generate some cash flow. So there's a lot of cool strategies around owning a home, and I'm passionate about it, as you can tell. But anyway, I'm excited. You're excited. You might not be excited. Dom's not excited. He's looking at me like I'm crazy. But speaking of Dom, let's throw it over to him and see if we can't get some of your questions going here. Dom, what do we have?
Taylor emailed us. I was listening to your podcast about landlord's loans. Can we use the loan for a house we want to Airbnb?
Hey, Taylor, that's a great question. So, yeah, and first of all, let me thank you for finding the podcast. If you guys want to listen to any of the back episodes of the show or find the Daily Dose podcast, go to mrmortgageradio.com. That's mrmortgageradio.com. We post a recorded version of the show up there every week, and looks like Taylor found the one where we were talking about the landlord loan. So, guys, that loan is really, really cool. And I'm going to answer your question, Taylor. I just like to take the long way there sometimes because I'm not sure everybody understands what that loan actually is. It's designed for investors who want to buy rental property. And the very cool thing about it is we're not looking at your personal income to qualify you for the loan. It's using the rental income or the potential rental income from the property. And I said potential because it can be vacant. It doesn't have to be already occupied by a tenant and generating income. So we look at your credit, we look at your assets, and then we look at the income that the property is or could be generating. And as long as the income from the property will pay the principal, the interest, the taxes, the insurance, and if there's any HOA fees, as long as that payment covers that at a 1-to-1 ratio, the landlord loan is fundable. So, and to answer your question, Taylor, it will work on Airbnb properties. There are all kinds of calculations now that can be done to determine the average number of days per zip code and the average nightly rent per zip code to determine what an income, monthly income can be produced from an Airbnb property. And guys, we're seeing a lot of interest in Airbnb. I was talking to Dom before we jumped on the air, and that guy's been traveling all over the country. And I imagine that, well, he probably didn't sleep in Airbnbs because they rolled the red carpet out for him. But that's the perfect example of where you can stay in some really cool locations. And I've got a friend who has a couple Airbnbs and they do very, very well with them. But yes, Taylor, the landlord loan will work for a property that you intend on using the Airbnb short-term rental strategy with. So thank you for that question. Hey, Dom, do we have another one over there?
We do. Shelley called in asking, if low rates drove up house prices, why don't you think higher rates will drive them down?
Wow. How much time do we have? We're only on the air for an hour. Hey, Shelley, that's a brilliant question. And it's logical, so I appreciate it. The cost of money, well, the cost of money did influence people to spend more than they probably would have because they're basing their affordability index on a monthly payment. But the cost of money is not what drove prices up. It was the careless overbidding from buyers and the lack of supply at that moment versus how many people were trying to relocate all over the country. So the last 2 years has been a bit of an anomaly, but it's a brilliant question. So what the cost of money did was make homeownership more affordable for more people. But you see what happened. We talk about it all the time. When we qualify a borrower for a mortgage, we don't look at the interest rate. We look at the monthly payment. You make X amount per month. That means you qualify for a monthly payment of Y, whatever that number is. And then we take that monthly payment and we determine how much money you can buy or borrow with that monthly payment based on interest rates of today. So I know it seems logical that the lower the cost of money, it's going to drive prices up. Well, it may have influenced the upward trend because of an increase in demand, but in of itself, the cost of money did not drive prices up. What people did was they looked at that budget number, and then an interest rate that was in the 2s or 3s allowed them to buy a much larger house than they ever anticipated, or at least a much more expensive house. So they went out there and they paid for that more expensive house. In hindsight, a lot of people wish they would have bought a less expensive house and just had a smaller payment. So that's why I say the cost of money in and of itself isn't going to drive down prices. It's making it more difficult for people to afford a property. But right now, I think there's 65 or 66% of the U.S. population owns their home, and with or without a mortgage. And in that number is pretty consistent historically. So it's not like low interest rates suddenly made people who hadn't given the consideration of homeownership that opportunity to jump in. They just money was affordable, so people spent more than they normally would have. And then emotion, you hear me say it all the time, logic and emotion rarely can occupy the same brain at the same time. And you asked a very logical question, but emotion is what drove that market, because if all the homes in the neighborhood were priced at $500,000, you could have bought that house for $500,000. But what happened was, and we talked about it, I think there's a back episode in that podcast library about Publix fried chicken, because You know, if you walk in and there's only one Publix fried chicken left, you race up to the counter before someone else can get it. That's demand over supply, right? More demand than supply. So what happened, in my opinion, was all of a sudden there were more people wanting to buy than were wanting to sell. So you got super competitive against the next buyer and you bid more money. And that's what drove prices up. If everybody would have just given the sellers what they were asking for and no more, at that point, prices would have stayed at 500,000. The same number of houses would have sold and the same amount of volume as far as units being listed and sold. That wouldn't have changed anything. But the emotion is what drove prices up. And people justified it logically in their brain by saying, well, I'm never going to have another chance in my life to borrow money at 1 or 2 or 3%. Let's go ahead and go all in right now. And that might be a brilliant strategy if you're early in the appreciation curve. But if you're at the end of the appreciation curve, that's not such a smart move. So I think that's a brilliant question. I do think it's easy to, correlate the two, cost of money versus value, but that's not what controls it, guys. It's supply versus demand. And we've used many, many, many examples. And the most recent one that we all experienced together was the pandemic. And we were paying $20, $25 for a, $7 or $8 bottle of sanitizer on eBay because we couldn't find it anywhere else. Who goes to eBay to buy toilet paper, hand sanitizer, and paper towels? Well, we all did during the pandemic, and we overpaid for it because there just was no supply. So, hey, Shelly, that was a brilliant question. I appreciate you stretching my mental legs on that one, but it was not cost of money in and of itself. Cost of money made more people want to take a shot at a bigger house, but it was the supply and demand equation. There were just more people wanting to buy. And guys, right now, there are still more people wanting to buy than sell. It's definitely not at the ridiculous proportions that it was 2 years ago, but we're still seeing homes sell in 14 days, 30 days. And historically, those are quick turn times on the market. So that's why I say right now, I think home prices are still supported where we are only because of that supply and demand equation. But hey, Dom's giving me the finger over there, and not the finger that you're thinking. He's giving me the other finger to wrap this up because we got to jump into a break. So you hear the music. We're going to be back in 2 short minutes with more of the show.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Here's another 5-star review.
We started our loan with a different company. They said we were approved, but at the last minute they told us there was a problem. I still don't know what went wrong, but thankfully our real estate agent told us about Mark. I was pretty stressed, but it's the perfect house, so we gave Mark a shot. He got it done. I'm not sure what was different, but I don't really care. We even got a better interest rate and with less money out of pocket than the first guy quoted us. It was a great surprise. Yes, I'm happy to recommend Mark and his Mr. Mortgage team.
Hey, it's Mark-eitel, host of the Mr. Mortgage Show. You hear me all the time talking about the need to have the very best team representing you in a real estate transaction. And that starts with a really great agent. If you've got a great agent, that's awesome. But if you don't, check out www.reallyGreatAgents.com. There you'll find the best of the best, regardless of the city they work in or the brokerage they work for. www.reallyGreatAgents.com. www.reallyGreatAgents.com. It's not every day that you need an appraisal, whether it's for a divorce settlement, estate planning, or maybe you're appealing a tax assessment, or you just want to make sure you have adequate coverage in your property insurance. When you need a certified appraisal, turn to my friends at SOFLappraisal.com. That's SOFLappraisal.com. Peter and his team have been appraising properties here in South Florida for decades. SOFLappraisal.com. And tell them you heard this on the Mr. Mortgage Show.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark-eitel, and you are listening to the Mr. Mortgage Show. Call or text your questions to 855-462-7292. That's 855-462-7292. Dom, my producer, is standing by, manning the Anytime hotline, and he'll get your questions on the air. If you prefer to do it via email, just visit mr.mortgage, never a .com. Just go up to your browser, type in Mr., hit the period, type in mortgage, hit enter, we'll pop right up. But hey, before the break, I was answering Shelly's question, which was a brilliant question about interest rates. If low interest rates drove prices up, then logically higher interest rates will drive them down. And I want to finish that. I want to give that concept its due, if you will. And Shelly, brilliant question. I want to say thanks for that one. Guys, if you missed that and you want to hear the beginning of the show, just go to mrmortgageradio.com and you'll be able to find it there. But hey, to the other half of that equation, higher interest rates driving prices down. In and of itself, as I mentioned, the cost of money will not do that. But what it could do, we could get to a point where interest rates reach a point where no one wants to buy anymore, and that's going to pull the supply or the demand side of that equation down to a number that now we're oversupplied. So until we're oversupplied, there's no incentive for a seller to reduce their price. Right now, sellers are giving contributions, reducing their prices a little bit, but the year-over-year numbers is what I'm talking about when I say prices are still appreciating. Maybe a house that was $400,000 in, July might be $390 today. That's definitely a discount, but that house traded last year for $350. That's my point. I'm saying they're still appreciating year over year because nobody trades houses every other month. You might trade your stocks like that. So when I'm referencing appreciation, I'm talking year over year appreciation. But Shelly, to your point specifically, interest rates could get to a point where there's so little demand that we're now oversupplied, but it's the supply and demand that control the pricing. And that's what the goal of increasing interest rates is, to try to slow down everybody's buying. Because guys, right now they're shopping like, my grandfather used to say drunken sailors, and he was a sailor, so he could get away with saying that. But my point in that is everybody now today is still shopping. I saw an article this week, and I should have printed it for the show now that we're having this conversation, but it showed consumer credit card debt is like an all-time high now. And we're going into increasing interest rates because every time the Federal Reserve moves that rate, your credit card payments are higher. And we're going into the most expensive time of the year as most people splurge during the holidays. So consumer spending is a concern in the overall economic cycle that we're in. We're watching that. We're watching repossessions. Car repos are up. So right now, mortgage foreclosures are still down. And the one really, really key ingredient in that is delinquencies. So when you start falling late on your mortgage and you're missing payments, you're in that delinquency category, and then you slide into the foreclosure category. Delinquencies are at historic lows. So there's no rumblings on the foreclosure market, but we are watching other consumer debt. And it's logical because people are going to let their house go last if they're in financial trouble. But Shelly, I wanted to finish that answer because you're right. At some point, interest rates could get to such a high level that people just don't want to buy. And then the people who have to sell might start discounting their properties. But we're just not there yet. And I don't think 7 or 8% interest does it. And hopefully it doesn't take a higher interest rate than that to get us in and out of this recession. So anyway, brilliant question. I just wanted to finish that up. Hey, Dom, do we have anything else over there?
We do. Here's a text from Neil. We are getting ready to start our approval process and have already called your office. Should we try for a regular loan or for a FHA loan? Thanks.
Hey, Neil, that is a great question, and I wish I knew your personal circumstances so I could give you a personal answer, but what I'll do is I'll check with the office and jump in and see if I can't give you some more insight. But since you asked the question on the air, what I'd like to do is just talk briefly about the differences between the two. So the conventional loan versus the FHA loan. And we all know during the pandemic, the FHA loan got a bad rap because a lot of people think if you've got to get an FHA loan, you're not a strong borrower. Well, first of all, if you're a seller, who cares? If the loan's approved and they've got the money to close the house, why would you care if they're getting an FHA, a conventional, or a loan from their Uncle Vinny, right? It shouldn't matter, but that's a whole nother conversation. The VA loan and the FHA loan got pushed to the side during the pandemic, and I really believe it was just due to a big pool of uneducated agents and uneducated sellers. But anyway, I want to answer your question. So the conventional loan will require typically a slightly higher credit score, and then the conventional loan will require a slightly lower debt-to-income ratio, a DTI. You'll hear us talk about it in the biz, if you will. And what that ratio is, it's the amount of debt against your income. That creates the DTI ratio, and that takes into consideration car payments, credit card payments, everything. And you have a front-end ratio, which is just your house, and then a back-end ratio, which is your house plus everything else. So in a conventional loan, you're going to have less debt. You're going to have a lower mortgage payment to meet those ratios. FHA, on the other hand, allows you to have a higher DTI ratio and a lower credit score. There are some FHA lenders that will go down to a 580 credit score. So there's a lot of flexibility in the guidelines with FHA versus conventional. Now, here's an interesting thing a lot of people are unaware of. Right now in this market, and it has been for the last couple of years, the FHA loan carries a lower interest rate. So it's attractive for a lot of people because the guidelines are more lenient and the interest rate's lower. Now, with FHA and conventional, if you borrow more than 80% of the purchase price, you're required to carry mortgage insurance. Now, this is the big glaring difference. With an FHA loan, that mortgage insurance stays on the loan until you sell or refinance the house. And you can't get out from underneath that mortgage insurance portion of the payment. However, with a conventional loan, at the point that the property has appreciated or you've paid the principal down to 78%, people will say 80%, but the number technically is 78%. So if your loan balance is 78% or less of the value of the property, you can petition, and by petition, it's usually a phone call or a form you fill out online. You'll call the servicer, the person who collects the monthly payment, to petition to have that mortgage insurance component removed. And guys, if you're putting down a tiny down payment, that mortgage insurance could be a couple $100s a month, depending on your credit score. So that's the big difference with FHA versus conventional is the conventional loan, you have the ability to drop that MI, we call it MI, mortgage insurance, at some point once the balance is reduced or the home appreciates to that point where that loan now represents 78% or less of the value of the property. And they'll usually want you they'll usually not review that for dropping the MI for at least a year. But that's the big thing. If you're going in with an FHA loan, you're not going to drop that MI on its own when you reach that value equation. Now, there's some other cool parts about the FHA loan. They have a streamlined refinance program that's simply designed to reduce the interest rate. So if interest rates fall back into the fives, which I do think we'll get back to the fives and settle somewhere in there in the future, you could do a streamlined FHA refinance, and it requires no income documentation and no credit review. As long as your mortgage has been paid on time, you can do a streamlined refinance. There's far reduced fees, and then you're just lowering the payment, but you're keeping the mortgage insurance. So there's good and bad, I guess, to both of those loan programs. A lot of it is going to have to do with how much money you want to put down and what your credit score is, and then most importantly, that debt-to-income ratio. And guys, I'm going to talk about that at some point today because it's not the credit score that holds a lot of people up. There's a big misconception about that. Debt to income kills dreams, not credit score, and we'll dive into that. Maybe we'll do that on the other side of this break. You hear that music, you know what that means. Dom has given me the cue. We'll be back into Sit Tight for 2 minutes, and on the other side of this break, we'll be back with more of the show.
It's not every day that you need an appraisal, whether it's for a divorce settlement, estate planning, or maybe you're appealing a tax assessment, or you just want to make sure you have adequate coverage in your property insurance. When you need a certified appraisal, turn to my friends at SOFLappraisal.com. That's SOFLappraisal.com. Peter and his team have been appraising properties here in South Florida for decades. SOFLappraisal.com. And tell them you heard this on the Mr. Mortgage Show.
Here's another 5-star review.
As a realtor, I have a bunch of mortgage brokers to choose from, but I prefer to work with Mark and his Mr. Mortgage team. In this crazy market, there is no room for error, especially on the mortgage side. Mark's team moves fast, keeps everybody in the loop, and makes things happen. They always give my clients a great deal and take the time to walk them through every step of the process. When you're considering a lender, I encourage you to talk to Mark-eitel and the Mr. Mortgage team.
Hey, it's Mark-eitel, host of the Mr. Mortgage Show. You hear me all the time talking about the need to have the very best team representing you in a real estate transaction. And that starts with a really great agent. If you've got a great agent, that's awesome. But if you don't, check out www.reallyGreatAgents.com. There you'll find the best of the best, regardless of the city they work in or the brokerage they work for. www.reallyGreatAgents.com, www.reallyGreatAgents.com.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark-eitel, and you heard the man, 855-462-7292. That's 855-462-7292. You can call or text your questions to that number, and Dom will get them on the air. And hey, we were finishing up that last segment and jumped into that break with a great question from Neil regarding FHA versus conventional. And I closed out my answer by saying, oftentimes it's not credit score, but DTI that kills dreams. And what I meant by that was, as you heard me explain to Neil, the FHA guidelines go all the way down to a 580 credit score. So oftentimes your credit score itself isn't the issue. Sometimes what's on your credit report pulling your score down that low could be a problem, but the score in of itself is usually something we can work around. So more importantly is that DTI ratio. And with FHA, you can have a pretty high back-end DTI ratio. So I would encourage you to look at both options depending on your scenario. And I know, Neil, you said you had already called the office, so I'll double-check with the team and see where you are, and I'll jump in, give you a shout myself, and see if we can't work you through your questions. But, hey, Dom, speaking of questions, let's keep them rolling.
Tony texted this one. I used my VA loan to buy the home we're in now. We refinanced into a conventional loan around 2 years ago. We like to keep this house to rent as an Airbnb. My question is, can I use my VA eligibility to buy our new house? It's in St. Augustine. Can you help?
Hey, Tony, that's a great question. And another Airbnb-er. Everybody's in on the Airbnb game. Whoever gave you that advice, or if you did it all on your own 2 years ago by getting your eligibility freed up and refinancing that into a conventional loan, that was a brilliant strategy, my man, because you can do exactly what you want to do. You can use your eligibility to buy the new property, and as long as there's enough distance between the two, you can keep that current property and rent it out, and Airbnb, do whatever you want with it. If you rent it and you get a tenant in there with a lease, then we don't have to count the debt on that property against you. With the Airbnb component, I'm not quite sure. I'm going to do a little research for you how we would need to document that so we don't have to count that payment on the current property against you. But if you have enough income to carry both, it's a non-issue anyway. But I'm going to look into that just to confirm what documentation we would need, because if you're renting it long-term, like a traditional rental where someone's in there for a 12-month lease period, all we need is the lease and you're off and running. So brilliant question. And yes, you can use your VA eligibility on your new primary residence. Hey, Dom, do we have another question?
We do. Marge sent this question. What happens if we take a reverse mortgage and then decide to sell to downsize in the future? Is there a penalty or any restrictions? Thank you. We love your show, and Dom too.
Hey, Dom's got a fan. All right, Marge. Yeah, Dom's a good guy. I'm a fan too. Brilliant question. Reverse mortgage does not have a prepayment penalty. You can take a reverse mortgage. You could refinance it later if you wanted to. You could sell the property and downsize just as you are giving some consideration to. That's a big misconception. The big four are: you don't own your home any longer. You sign it over to the bank. Not true. You own your home. The reverse mortgage is simply a loan with a lien position, a first lien position, just like any other loan. It's still your house. You just have a mortgage lien on it. Another big misconception is if the property is worth less than I owe when I die, I've burdened my estate with this additional debt. Again, not true. It's a non-recourse loan. If you owe more than the house is worth at your passing, your kids can slide the keys right across a desk to the bank, and it's up to the bank to deal with it. They're not required to pay any of that loss. And the good news is that that's regardless of your other positions in your estate. You could have millions of dollars in cash and gold, bullion and stock and Bitcoin and whatever you have. The bank will take the loss on the house. And then to your point, there is no prepayment penalty, no restrictions with that loan. So you could sell it at any time and downsize. So brilliant question. I appreciate that, Marge. And we are talking to more and more people about reverse mortgages right now, because the fixed income senior is just, they're treading water. And I know Social Security's got, what is it? I think it's a 9% increase, 8% increase next year, but we're at 8% inflation. So what does that mean? You just tread water in a slightly deeper pool. I don't know. But yeah, we're talking to a lot of people because that equity is a saving grace for a fixed income senior at this point. But hey, let's keep them rolling. Dom, what do we have?
Lester called in with this one. I've been working on my credit. It's getting better. What score will I need for your 100% first-time buyer loan?
Hey, Lester, another great question. So you heard me say earlier the FHA program will go down to a 580, and then that new 100% loan that we have for first-time buyers. And just so everybody listening knows, first-time buyer means you haven't owned your primary residence you haven't owned real estate in the last 3 years. So if you had a house 4 or 5 years ago, you're a first-time buyer today. That particular loan program, which is an FHA loan, but it's a specific program for this first-time buyer, it requires a 620 credit score. And again, for the people who might be hearing this for the first time, this new loan program is designed to go to 100% of the purchase price, and the seller can contribute up to 6% of the purchase price for your closing costs. So you get a first loan at 96.5%, which is the typical FHA loan. And then there's a 3.5% grant that lays on top of that. That gets you to 100%. And again, 6% contribution for your closing costs. The super cool thing about this program is you can be a first-time buyer regardless of your employment classification. You can qualify. And what I mean by that is we talk a lot about the Hometown Heroes program, but that's for specific classes of employment: teachers, police officers, first responders, medical personnel. This one, you could be the manager at the store in the mall. You can own a restaurant, self-employed. It's open to any first-time buyers as long as you meet the credit and the income guidelines. So I'm super excited about that. The other thing that's really, really exciting is that 3.5% it accrues no interest and it requires no payment. It's completely forgiven at the sale of the property, or should you refinance at a later date. So it's basically like a gift, which is, in the world of grants, it's pretty exciting. So that loan program, if you want to do that stacked 100% FHA loan, you're going to have a 620 credit score. But I would encourage you to continue working on your credit. If you feel like you're close to those numbers, give us a call. We've got this really cool program that we offer called a soft credit inquiry approval. And what I mean by that is we can do a soft credit inquiry and it doesn't affect your credit score at all. It's not an application for credit. It's the same way Amex and all the big guys look at your credit before they send you that pre-approved offer in the mail. It gives us a chance to see your credit score, see your accounts, and then we know where you're going to fall in the guidelines, and we can do the pre-qualification based on that. So super exciting. Hey, let's see if we can squeeze one more in.
Barbara called in asking, we used an equity line to buy our neighbor's house. We now have it rented and would like to mortgage it, take some cash out, and pay off our equity line. Is this possible?
Hey, Barbara, it is possible, and I followed that carefully. So you had a chance to buy the neighbor's house, and I don't know if it was because, no, it wasn't because you didn't want neighbors, because you said you rented it out, but pretty cool. My neighbors are moving right now, so I do understand the allure of owning the property right next door as a rental. I don't know that I would want my tenants right next door to me, though. But to answer your question, sounds like you took an equity line, bought the property for cash, and now you own it for cash and you want to do a mortgage on that property. So there's two ways to do it. Depending on how long ago you bought the property, there's one loan program called delayed financing. And what that means is you get the same loan program and same interest rate as if you just were making the purchase right now today. The other way to do it, it's going to be a cash-out refi. And I know that sounds counterintuitive because we're calling it a refinance even though there's no financing on it. But anytime you pull cash out of a property and put a new loan on it, in the world of underwriting, it's considered a cash-out refinance. And a cash-out refinance always carries a slightly higher interest rate than a purchase mortgage. So, but either one of those two would work, and then you can pay your equity line off on your property. And the cool thing is you don't have to close your equity line. You could just pay it down to zero and keep it just in case another opportunity like that in the neighborhood pops up. But hey, congratulations, and thank you for that question. You hear the music, you know what that means. That's my cue. We'll be back in 2. Sit tight for 2 minutes, and on the other side of this break, we'll be back with more of the show.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Here's another 5-star review.
We kept our business above water with credit cards during the pandemic. I'm glad we did. Business is better than ever. But I didn't want to be a slave to those credit card payments. I called Mark about the rec loan he advertises. Long story short, we did a rec refinance and paid off everything, even the car. Now we only have the mortgage payment. We're saving a bunch every month. Yes, we are happy to recommend Mark and the Mr. Mortgage team.
Hey, it's Mark-eitel, host of the Mr. Mortgage Show. You hear me all the time talking about the need to have the very best team representing you in a real estate transaction. And that starts with a really great agent. If you've got a great agent, that's awesome. But if you don't, check out www.reallyGreatAgents.com. There you'll find the best of the best, regardless of the city they work in or the brokerage they work for. www.reallyGreatAgents.com. www.reallyGreatAgents.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back, and if you want your questions on the air, call or text 855-462-7292, or shoot them to us via email by visiting the website, mr.mortgage, never a .com. Just go to your browser, type in Mr., hit the period, type in mortgage, hit enter, and boom, we'll pop right up. But hey, guys, your questions are my favorite part. Let's see if we can get to another one. Tom, do we have another question?
Yes, Connie just sent us a text. We're vacationing from We're vacationing from Canada and want to buy the house we're renting. We're not citizens. Are there options for us?
Hey, Connie from Canada. Yes, there are. So there are a lot of loan programs for even foreign nationals. You can be, there's a load of programs. So yes, you can buy a property. You can probably use the landlord loan and rent it out when you're not here, and then just block it out if you do an Airbnb deal on it. Block it out so it's available when you want to be here in sunny South Florida. But yeah, brilliant question. We do it all the time. We just closed a transaction for a gentleman. He's going to ultimately move here and make it his home, but we used the landlord loan to get him into a property, and he too was from the Great White North. So happy that you're with us, and I hope that answer helps. We appreciate the question. Guys, wow, we've had some great questions today. I mean, we started off talking about landlord loans, and we're wrapping it up talking about landlord loans. We talked about low rates driving prices up and the probability of increased rates driving prices back down, and can you pay a reverse mortgage off early? Is there a penalty? We talked about VA loans and the eligibility requirements to buy a new primary and keep your current and rent it out. A lot of good stuff, guys. You do not disappoint. I appreciate all the questions this week. Hey, I want to ask you a favor, though, while I have a second. If any of this is interesting to you, if it resonated, I appreciate you sharing the show. We're always trying to grow the audience. Encourage anybody that you know who might find this interesting to listen. You can find all of the back episodes, the podcast, all of the recorded versions of what we do. Dom posts them up to cyberspace, and you can find all of them at the MrMortgageRadio.com or the MrMortgageShow.com. Either one will get you there, but MrMortgageRadio.com is a little easier to remember. And yeah, you can always visit us online too at Mr.Mortgage. No .com there, just type in Mr.Mortgage. But I would greatly appreciate, I'm hoping I can count on you, if you have any friends or family or coworkers who are thinking about real estate. Is it a good time to buy? Is it a good time to sell? Hey, I heard that crazy guy on the radio talking about that weird loan program. This might help you. If you've got friends or family or coworkers who are in the market for real estate or mortgages, please send them my way. I'm hoping I can count on you. And you can just give them one of those links, MrMortgageRadio.com, MrMortgageRadio.com, or The Mr. Mortgage Show. Facebook, yeah, I forgot about Facebook. We post all of the data that we use up to Facebook, and you can find the show at The Mr. Mortgage Show on Facebook. So I appreciate everybody's participation. As I mentioned, we had some great questions so far this week. But let's throw it over to Dom and see if we can get another question in.
Real quick, Ernesto sent this email. I own a small apartment building. I'd like to pull some cash out to buy another, but there is a prepayment penalty on the current mortgage. Is there an equity line for investment properties? My bank doesn't do investment equity lines.
All right, that is a great question, and no is a common answer from a bank on an equity line for an investment property. So yeah, here's one thing you can do, Ernesto. There are some second mortgage products for apartments, commercial properties, investment properties, and we can do a cash-out second mortgage, which will accomplish the same thing. Pull the cash out of your property and go buy another one. And guys, we affectionately call that the BRRRR strategy, where you buy the first property, you rehab it, you rent it out, you refinance it to pull your cash out, and then you repeat the whole process again. But great question. You hear the music, you know what that means. We've wrapped up another week here at the Mr. Mortgage Show. Dom and I thank you for being part of our day. We always like being a part of yours, and we will be back next week. Same time, same station. Have a fantastic holiday and meet us back here next week.
That's a wrap. Join mark-eitel next week for more thrilling, edge-of-your-seat discussions about real estate and mortgages right here on The Mr. Mortgage Show.